Welcome to Blaxe Academy, and also welcome to our monthly market mix. Our monthly market mixes are designed to give Blaxe Academy students an opportunity to see the markets from a broader view so that they can find more opportunities, more trades, more investments. Let's begin. In our last monthly market mix, we saw that the market did indeed sell in May. Now, whether or not we go away during the summer is to be seen. We're going to look at the major indices, S&P, NASDAQ, small caps. But center stage for the markets goes to the bond markets. And even though the stock market in May had one of its worst months in years, the bond market was far worse. The losses had not been as bad as they had been in 50 years. And specifically in U.S. treasuries, we haven't seen such losses since the Civil War. We want to talk about a situation in the world's third largest freestanding economy, Japan. Right now, the Japanese yen is at a major sell-off point against the US dollar and other currencies, and we'd like to talk about what that means for that economy, for the world economy, and maybe some opportunities for those of you who are interested in currency markets. The CPI is still kicking at multi-decade highs. The Fed is still full steam ahead on interest rates. The U.S. housing market is showing a different color, and this, as ugly as it may be for sellers, may be a bright spot for buyers or not. And of course, we have the Russo-Ukraine war, and we'll talk a little bit about commodities and more FX, but specifically we'll talk about crude oil. But first, we're going to look at our indices to get this started off. As always, we begin this view of the indices with the S&P 500. In last month, in May's monthly market mix, we were looking for a bit of support to happen around the yellow line at this 27.2% retracement. If you're new to technical analysis, you'll understand that these horizontal lines represent areas of potential support. For those that understand, these are Fibonacci levels, and again, they imply support for the market. If you're a Blaxe Academy student, you understand that these provide future areas of support and also resistance to the market. In May, we didn't get our wish at the 27.2. The market was in a pretty free fall decline through May, as it has been, as you can see, since the beginning of the year. So 5 months into the year, the market has sold off. At any time you look at any market news, you'll see this sentiment is reverberated. Even the Fin memes talked about how badly people's portfolios were down. But looking at this as a market technician, I don't really see any worry, because as you can see, even though it didn't hit the level that we expected, there were two other levels below it. And quite interestingly, the level around 3,800, 3,818 in the S&P 500 index seems to have held, and the market bounced higher. As we sold into May, the end of May offered a reprieve, at least in the short term, for some investors. For traders, I think this has been a really good environment. Taking a slightly closer look in, you can see how some of the levels of support and maybe in the future resistance may hold out. In the short term, I do think that even though now I've come down to a lower time frame, I see room for the market to move slightly lower, maybe to retest that 38.2% level that we can see as we come back out here, and then maybe move higher. The pressure on the market still remains with the Fed raising rates. The higher they raise rates, the more pressure they're going to put on the markets. It's not a one-to-one correlation, but given all the other factors that we'll talk about, the pressure remains that as the Fed continues to raise, as they raise towards the more nominal target, the stock market is going to experience pressure. But technically, it doesn't look that bad yet. To be honest, I may start to get a little bit worried as we approach the 50% level here, which I'll highlight. And we may actually begin to reflect more of our theme, which again is midnight in the markets, should we come back as far as the 61.8%. Depending on the composition of your portfolio, depending on if you have a lot of popular equities in your portfolio, if by chance, and I'm not saying that this is what's going to happen, I'm never saying that this is what's going to happen, that we're going to talk about possibilities. But if we get down to the 61.8, the market is really at a critical level. But for now, I think we'll be bound maybe by the 38.2, but as low as 50%. And it's significant because if you look at the actual lows, this is the low that was created by the coronavirus lockdown and pandemic. We rose very quickly. It's very natural for markets, no matter what level you're looking at, for them to recede or retrace to these common levels. We thought the 27.2 was going to be it. It was not. 38.2 is common if you know your Fibonacci's. If you don't, come see us at our Blaxe Academy courses. And the 50% level is also a very common level. There's actually one in between here that you won't see often at 44.7 that may provide some support during the summer as well. But that's just the S&P. I like to look at the S&P as a broad market index, but I also like to complement it with looking at other indices too. If you watch the rest of our monthly market mixes, you'll know that QQQ, which is the ETF that tracks the NASDAQ or the tech stock index, is also one that we look. And as I switch charts, you can see that this is also a very similar look, but it has already penetrated below what we were expecting. I was expecting it to hold at 38.2, but it penetrated lower and touched the 50%. It still looks a little weak here to me, but not interminably so. I don't actually see too much, but still I note the same levels that I think we get to a critical point because of the importance of this area of support at 61.8. But for right now, much like the S&P, the NASDAQ touched 50%. And so in the short term, some of the portfolios, as we changed over in the middle of May, and you really can see this in the middle of the month. The first part of the month was just like the rest of the year. As May commenced, you could see in NASDAQ, which tech stocks tend to be more volatile than the broader market. It's one of the more volatile, more exciting sectors of the market. And you can see that right into the middle of May and, well, maybe towards the end of the May as I'm looking at tech stocks. But as we rounded out the month, you started to get a reprieve. The sell-off started to cease, and you could see prices of these assets, especially in tech, start to rise. Again, I still think the pressure is to the downside. Tech stocks being sensitive to economic changes, like some other sectors as well, you will see that they tend to be very sensitive to investors' opinions of interest rates because, once again, tech stocks have a lot in common with another area that we will talk about with startups, in that they are very sensitive to economic changes on borrowing and lending for the major institutions, for private equity, for a lot of the people who would back these companies, as well as the consumers that are looking to use their products. But again, in the grand scheme of things, these are our levels. You can study them. And before we leave the indices, I want to look at one more, which is Russell 2000, which is the small cap stock index. Remember last time, small cap stocks gave us a clue about what the NASDAQ and the S&P might have done. And I highlight this, that once again, we have hit sort of a critical level, a more critical level in small caps than we have in the S&P or the NASDAQ. And what I mean by a more critical level is we have two different forms of support that happen around this 50% retracement level, which again is itself a support, but we already had some natural price action support that was happening with the peaks in December 2019 before we headed into 2020 in the lows. This forms, in technical analysis, a stronger support level. And you can see, just like the other indices, the small caps have bounced higher. I'm going to move this just so slightly. However, again, there's still room for movement down, maybe to retest those levels, and they could go lower. But I think it will be key watching the small caps here. If the small caps break cleanly below 50%, that may presage a move much lower in the markets and maybe more problems. But if not, then we can start to look for more upside as we continue through the year. But again, this is just a look at the indices. What we want to talk about now is a market that doesn't get looked at a lot unless conditions happen as they have, and that's the bond market. Across the world and in the US as a whole, we had a massive sell-off in bonds. Bonds had the worst month performance in May that they had had in decades. Bonds tend not to be as volatile as stocks because of their makeup, because of their composition. And this is one reason why long-term institutional investors with large sums of money now like to invest in bonds. Bonds offer, generally speaking, some level of security. They're not guaranteed, but they offer some level of security, and in some cases, some generate income for portfolios. And even in basic conventional portfolios, bonds are often complemented to stocks. You tend to buy a certain fraction of bonds, typically large, compared to stocks, such that the theory is as stocks and equities go up, bonds go down, and vice versa. When stocks are stressed, investors typically run to bonds. The problem with that is recently, and not just now, but recently in the last maybe 2 decades, we're starting to see less of that happening. In fact, in 2008, 2018, and also in 2020, we saw sell-offs of bonds alongside equities. This kind of goes against conventional theory that is behind what's called the 60-40 portfolio, which if you have an investment plan, a retirement plan with an employee or something of that sort, you probably have a 60-40 or something similar as a strategy. Well, bonds in May sold off just as hard as equities, so they did not provide the level of support in the short term. Now, that may change, and we're going to look at the bond market just briefly. But I wanted to bring this out to show that oftentimes, as you're learning about the markets, one reason to learn about the markets is to dispel some of the common strategies, because as the markets change, what is often common itself changes. So looking at the bond market and seeing how the bond market works from a technical perspective, looking at its chart, and also understanding what happens may give you investors and definitely you traders some opportunities to go on in the future. Let's take a look at the charts. Here we have a chart of the US 30-year treasury yields, which is in the green and red, plotted against the actual bond future, which represents the actual price of the coupon, in the orange. What should stick out here, we're not going to spend an entire amount of time here, is that there's an inverse relationship between the actual bond price, represented in the orange, and the yields, represented in the green and the red. We can see that there was a relative peak, not quite the highest, in late 2018, and bond yields, that's the actual, I guess you could call it, income producing part of the bond, the IOU part of the bond, if you will. Bond yields dropped precipitously on into 2020, which again is pandemic. The bond prices themselves rose during this period. Technically, this is what's supposed to happen. And you can see this little spike here is actually what happened as bond prices themselves, demand for the actual bond, as investors fled for safety, for safe assets like bonds. Treasury bonds are considered safe because they're backed by the strength and the might of whatever government is issuing them. Here we're talking about the United States, but it could be for any number of governments or even corporations issue bonds, or even municipalities, local municipalities. But here, U.S. Treasury is considered to be a very safe investment. Often a low yielding, relatively speaking, investment. But if you want something safe and secure, place your money, big time investors will buy bonds. Now, again, shorter term bonds have lower yields most of the time against the longer term, and 30 years considered to be a long term. You can see that the 30-year spiked and since has receded. Now, as you can see, The true inverse relationship here is between the bond price in orange and the bond yield is actual paid. What you can see is since 2022 has started, bond yields have surged much higher. Well, there's been a sell-off in the price. This inverse relationship happens. I've said before that there's an implied relationship between the stock markets and bond markets. Let's check that out. If I put the S&P 500 index back on here, you can see that there's somewhat of a relationship between bond yields and the stock price, but you can actually see that the bond price itself and the stock market tend to have a more inverse relationship, except very recently. You can see that yields have gone up, bond prices have gone down. This was different than in 2020. Typically, you see the bond prices go up here because this is why investors buy bonds to shield their portfolios. As there's big panics in the market, typically you will see this relationship. But again, as I said before, this relationship has broken a few times, which has made me question and other financial operators question the validity of whether or not the environment supports bonds offsetting the losses in the stock market. And as we can see in May, both bonds and stocks cried together. Now, if we take a slightly longer look, we can still see, again, some of the relationships. You can see here that in the orange, the actual price of the bond shot up during the financial crisis. Bonds also rose if we go back further enough to when the market peaked out during the dot-com bubble. You can see the actual bond prices moving up as well. And so, again, that inverse relationship exists to some extent, but it seems to be a little broken once we get to 2020, 2022. Maybe 2022 is just an odd year, but it's something to be mindful about, because if what once worked does not work, we have to consider we must change the way that we think about things. We'll be tracking this as interest rates continue to rise. One more thing I will put into here that's important about bonds, and some of you probably already know this, is that what's also tied to bond markets is your mortgage rates. If we look at the long-term and 30-year mortgage rate, which is very common in the United States, in yellow here, you can also see that it's correlated with bond yields, long-term bond yields, long-term interest rates. Trust me, the banks lend out at rates that are comparable to what they are also getting from U.S. treasuries and the benchmark interest rate rather. And as you can see, really from the middle of 2021, almost leading in this situation, mortgage rates started to rise. And this is before the Fed actually started raising rates again. But mortgage rates started to rise, and you can see this in lock and step with bond yields. As long as this continues, it's going to put some pressure on the U.S. housing market. And we will be watching this because, again, this is another piece of the puzzle that is the entirety of the financial markets. One thing I'd like to mention about bonds before we move on is the fact that it's not all dire out here. If we look at bonds over the long term, and as with most investments, you should, bond investors right now, even though they're shying heavily away from bonds, and shy, I mean almost tongue in cheek, because again, it's been the worst it's been in over a century in some cases. If you look at bond investors that remain continuously invested and actually continue to do so over the long term, falling rates, well, again, rising rates, excuse me, and falling bond prices may actually benefit them. If you look at just a 10-year situation here where we have unchanged yields in blue, a scenario where the yields rise 100 basis points or a whole point, which of course will make the actual value of the bonds fall in the light blue, or the inverse where the yields fall and the actual bond prices rise in the yellow. You can see that over a long period of time, if bond buyers continue to buy longer dated bonds, that the actual portfolio itself will start to correct and go higher, as seen in the light blue here. Then in the short term, if you were buying the bonds that the actual coupon prices rose and the yields fell, because if you look at it over time, if you're buying the actual bond itself at a lower rate, your return on investment over time is going to be less, even though you're buying, I guess you could say, a less highly valued bond in the short term in the light blue, but you're buying it at a higher rate of return. If you keep doing that over time and things start to normalize, then you actually get the bond's value itself returning to par. And then you also have the higher rates in which you purchase them at. So big time bond market purchasers, and if you look at some of the institutional buyers, they may be looking at this situation that we have now. Well, maybe not exactly right now, but in the long term, this could honestly be buying opportunity if you're looking at it from a much longer standpoint than just this is the worst bond market sell-off in a month. But that was just for the silver lining. I want to turn more now towards why we're still talking about midnight in the markets. And that takes us to basically the profitless companies, IPOs, tech, and a lot of the stuff that we love to buy or have loved to buy the last few years. Interestingly enough, as the market sold off, we said that the larger market sold off to about 38.2% of its value since the lows of March of 2020 to the highs of December of 2021. Well, startup companies, IPOs, have gotten slaughtered in 2022. There's a lot of reasons behind this. Generally speaking, you could say that this market sell-off was a deleveraging. You had a lot of sweet, cheap money that was being put into a lot of overhyped companies. And very interesting, we can see that this cheap money cash boom, as you look at it over the last 50 years, you can see that around 63% of U.S. publicly listed manufacturers, just in the manufacturing sector, not looking at tech, not looking at consumer discretionary, 63% of manufacturers were unprofitable in 2020 compared to 19% 50 years ago. So you can see that a lot of hot money, cheap money, was being piled into even the manufacturing sector, which is not known to be a hot money sector. Almost 80% of IPOs were unprofitable in 2019. And that's significant because that's before the pandemic. A lot of this was fueled by private equity gains. Again, the companies buying up the companies before and then selling them off in exit events in the stock market, selling them to you in these IPOs. This is one reason why I've been very bearish, even vocally so, about buying into IPOs. And we've seen what looks like the apex of this, and I'll show you another index in just a second. But what kind of goes along with this is you can see we had a height, a peak IPO valuations at over $250 billion in Q1 of 2021. You can also see that this correlates with the stock market hitting its peak values in 2021. You can see small caps and tech and a lot of the foreign markets also hit peaks long before the S&P did. This correlates with this overvaluation, if you would call it, and then the subsequent loss of value in the stocks in the quarters until here we are now. And right now, fundraising is at all-time lows since it's been recorded. There may have been fundraising levels lower than this, but they have not been recorded. So we went from boom to bust, and it reflects in the charts. Let's take a look. This Renaissance IPO ETF tracks a lot of the very new companies that have come into the market. It's a way that you can get exposure to IPOs without having to buy them directly. That's one of the benefits of mutual funds and ETFs, is being able to get exposure to a market or a sector of a market without having to actually do a lot of the digging. That has an upside, as we can see. And from March of 2020 up until February of 2021, you can see that this IPO ETF was booming. This corresponds with the last graph that we just saw that had the IPO valuations maxed out. This thing has lost most of its value. And I do mean most, and it's not even close. After going up so much, It's down over 65% from the peak. And this is just for new IPOs, new companies coming out. But this corresponds to, if you were to look at, let's just say, the NASDAQ, for example, you can see the sell off there. If we were to go look at some other companies in particular, you're going to see even more of a slump. But you can see this is fairly correlated. It actually led it. The IPO index hit a peak, corrected lower, tried to retrace, and then you see the big deluge. And that corresponded with the later in the year. Remember, tech market actually led the larger market lower, and small caps led those lower. So you can see small caps, tech, you kind of see the picture. Hope so. Anyway, if we're to look now, and you say, well, what's the fallout of this? Well, one of the things that is of very importance to the economy as a whole is a lot of our quote unquote favorite companies, these tech darlings that rose so much in value during the coronavirus rebound, they got hit hardest. For example, if we were to look at Uber's a company that recently said that they were shedding some of their employees, a lot of their employees, up to 10%. Uber, you can see they peaked in February. I guess I can actually overlay that. Let's go backwards a bit. You can see the strong correlation here with Uber in the orange and this Renaissance IPO. And granted, I know that, Uber IPO'd a few years ago, but you can see the correlation of this industry with this single stock doing about the same thing. There's a little bit more bobble here, a little less correlation in this period, but that happens. But you can see that both of them ended up going way lower. Same thing could be said of Carvana, which is another company that recently after the earnings said, hey, we're about to cut some jobs. And Carvana was a darling of coronavirus. It surged, made its peak later, but as you can see, Carvana's lost most of its value. It's actually back lower now. Let's take a look at that. It's back lower now than it was at the lows of coronavirus. It was another company that announced that it had to lay off workers. If we look into companies that benefited a lot from the stay-at-home work life, Coinbase, for example, another one that people thought was great. It doesn't have the data because, again, this is an IPO. IPO is late, but if you just imagine here, you can see that its price performance is correlated very strongly with this Renaissance IPO ETF. So the same fate befell Coinbase, and I can probably put up another one that would benefit that comes to mind, and that would be Robinhood. Very similar, if a bit explosive, but very similar fate. You can still see the correlation, even though you do. So once again, a lot of these, the startups, the tech darlings, a lot of these profitless companies have now had a mean reversion, a very strong mean reversion, and the market has had an aversion to them. The bad part about this, other than, if you've been very long in these and you're trying to hold out, you've lost an incredible amount of value. Now these employees have to go find other places to work. That is an issue for the economy, especially in an economy that we've been talking about for a while that is suffering from inflation effects. Speaking of, where are we in terms of inflation? We're pretty much still at the highs. A lot of the reports found reprieve in the fact that consumer price inflation, as it was measured in May, was at 8.3%. But keep in mind that the 40-year high in inflation was 8.5% in March numbers. Now, remember, what's reported in May is actually for the month prior to. So for consumer price inflation, it's the month prior to that is reported in the active month. So in May, we're reporting April numbers. In April, we're reporting March numbers, as you can see in the chart. And in April, we're at 8.3, but March numbers, 8.5%. We're still very elevated as we're looking forward. And even though analysts are saying that we expect that the numbers that are going to be reported for May and June in just a few weeks are going to be less, I can tell you they were not. It was still higher. We were still at 8.4% in May. Peak inflation has not hit yet. We may be at the peak, but we haven't had enough of a fall off from this high inflation. And it's not just in the US. is worldwide. As you can see, some of the areas, you know, you take it with a grain of salt. We're not in Argentina or Venezuela or Turkey or, Sudan or any of these nations that are seeming to have unreal levels of inflation. But as we can feel in your pocketbooks, at the gas stations, the United States, with having such a large economy, again, the world's largest freestanding economy, having inflation above 5%, we're almost double that, and expected to stay that way for a while, is going to impact us all because our economies are much larger, much more complex and wide ranging. So they can call for peak inflation as much as they want. It's still here to stay, and we're still going to feel the effects. And this is going to affect, again, the stock market as well as your savings rate. So be mindful of that as we go forward. Now, speaking of pain and savings, this is a chart that we formed a few monthly market mixes ago and is still very relevant. This is like crude oil futures. I've been tracking this for several months, specifically, not just since the Russo-Ukraine war, but really since the end of 2021, when I started to see crude oil start to bound much higher. And of course, it was exacerbated by the war that you can see here that kicked off in February, but we're still elevated. At first, when we looked at the pattern, a lot of other analysts were calling this a triangle. I never saw it as a triangle. It didn't have the right structure. But what I do see, again, as you can see me using the horizontal lines, these are nothing but retracements. Looking at these retracements of what was, you can see that the levels, each successive level here, the market moved a little bit lower and then rebounded higher. You can see it's touching successive Fibonacci levels. There's a chance, as we look at this structure, and you will learn more about what we mean by market structures and patterns if you take our Foundations of Investing course, Foundations of Trading course specifically, and some of our other courses on how to trade futures and other markets. But our specific brand of technical analysis seems to see that there's a chance, again, not a guarantee, not even really a prognostication, that crude oil prices can abate from these prices, from these highs, if we do not get above this 78.6% range, which is around $122 a barrel, which is currently the front running contract, or maybe a high around 126, maybe 127. The way that the market is chopped higher seems to indicate that it is running out of steam. And one thing that will help is, as the Fed begins to raise interest rates more and more, it makes the dollar more valuable. This has a mathematical component to actually making the price per barrel go down lower because, again, crude oil, like many commodities, is priced in dollars. If the dollar becomes stronger, then the price per barrel is hypothetically going to be less. This, of course, doesn't assume any increases in demand and things of that nature. And we will talk about some of the elements of what may influence that demand, but mathematically, Fed rates going higher, pain at the pump, relatively speaking, may abate here. And if I'm just looking at this chart technically, what you have since the highs in early March until right now, this pattern here is what we would consider to be a flat. As long as it stays below this 88.6% range, it is considered to be a flat. And at some point, it has a higher probability of moving lower. How much lower? Not yet certain. We're not even certain that it is going to move lower, but the pattern itself seems to indicate that it may move lower, and the fundamentals behind that driving may be higher interest rates fueled by the Fed raising rates. But for now, let's look at a little bit more of the crude market dynamics really quickly. One of the things that's not really talked about in context when you say pain at the pump or crude oil or talking about Russia and how it all works is that the United States is actually the world's largest oil producer. That means we produce more oil than anybody else on the planet. The interesting thing here is that we're also the second largest oil exporter and also an importer too, China being number one. But most of our oil does not come from Russia. Russia's number three on the list, as you can see here, accounting for almost 8%. But our nearby neighbors, Canada and Mexico, are where we get the largest chunk of our oil and petroleum products too, not just crude oil, but a lot of different petroleum products. Most of it comes from Canada. In fact, more than half of it. Reason is actually pretty simple. It's geographic proximity. As with any commodity, any product, the cost of getting it from where you made it to where it's being used increases with distance. It increases with, the complexity of the types of products and things of that nature. So if you look at it, even as we're importing and we're exporting, all of the free trade agreements in North America are there for the purpose of making sure that we have access to, relatively speaking, fairly cheap fuel. Now, the problem is, again, Russia is third in line. So that 8%, believe it or not, has to be accounted some. So I can't say in truth that, oh, the Russian war won't affect some of our fuel prices. Yes, it will, which is why you'll see in the political sphere that Biden has been talking to OPEC and OPEC plus countries about striking some deals. But I think that's just grandstanding, to be honest. The fact of the matter is, I think the larger effects of inflation, just like we saw happen before the war kicked off, having those abate is going to have a much greater effect on what we see at the pump specifically than looking at this. Because again, if you look at it, our issues would be with Canada and Mexico, not with Russia. That's just a tidbit, but I wanted to give the overall picture here to make sure that we're not just sucked into what the media says about how Russia directly impacts it. There is some impact, but it is not as all-consuming as you might expect. Now, before we close, I wanted to show an opportunity that presents itself in the larger, broader market, and specifically in the currency markets. But first, we have to take a look at Japan, and specifically Japanese inflation rates. Inflation has been a long-standing issue since the coronavirus stimulus programs around the world enacted by central banks to make sure that the world stayed afloat during the pandemic. It is, as we've talked about in the United States and elsewhere, raised asset prices, raised the cost of living, and presented a pretty negative thing for most of the world and its citizens. However, in Japan, the economy, which is still very large, it is the third largest freestanding economy in the world, has a curious inflation outlook. Japan has experienced since 1991 was considered to be 3 lost decades of economic growth, following wild speculation and pretty much heinous bank lending in the 90s. Japan's economy has been fighting deflation, or at least disinflation. So the rising inflation rates around the world, and as we're starting to see now in 2021, 2022, has a curious effect in Japan. Japan's economy, which is direly needed stimulus, so much so that the Japanese government has been buying bonds daily to keep the rates low and to stimulate the economy into some form of growth, now is looking to, for the first time in years, may meet its inflation target. But what does that actually mean? Well, let's take a look at a chart. The best chart to explain the opportunity here is probably the US dollar versus the Japanese yen pair. In this chart, we can see in blue, as the chart rises, the United States dollar rises against the Japanese yen. And we can see that recently, as it's still climbing, has climbed since the beginning of this year, since 2021, actually. The Japanese yen is at the highest rate that it's been in almost 20 years. Well, if charts mean anything, and the rates are as they are, and inflation is a thing around the world, the opportunity presents itself here that if Japan's economy inflates to a point to where either the Japanese government or the central bank itself, which is unusual, has to take action, then there's an incredible opportunity to actually long or to buy Japanese yen, which is unusual, against the US dollar or some of the other currency pairs. While this is a speculative play, the idea here is that if you look back over the last 20 something odd years, the Japanese yen has only been this weak against the dollar a few times. You can see if you look at the 130 level, where it takes 130 yen to equal one US dollar, you had a period in 2001, 2002, and you had a period in the late 90s as we had the great Asian asset bubble burst. In fact, since I've actually been trading currencies, which started in 2005, there have only been a few times since the Japanese yen has been over 124. Here we are, well above all of them except for the late 90s. The opportunity is simple. This is a mean reversion play. We'd have to talk about it in more specific terms and more technical terms, but given the fact that if the dollar, and this is hypothetical because the Fed is actually planning on raising rates at least into 2023. But if the Fed, for whatever reason, stops or pauses or even hints at pausing their interest rates, and the Japanese bank, the Bank of Japan, hints at raising rates, there could be a quick inversion in the price here. This is just one of the ideas, but let's give some validity to it. In our last monthly market outlook, we looked at a chart of the US dollar as we have here, and I had my Elliott wave count and some of my measurements, and we can see that the level above in yellow, this 50% level, which is representing 50% of the range of the move from 2011 up to January of 2017, added to the low here. And this is a very distinct form of technical analysis. If you haven't heard it, come check us out. You can see that we hit that 50% level last month, and we've moved lower. Now, I can expect the US dollar to keep moving higher as long as the implication of rates remains here in the United States. But for whatever reason, if this 50% level provides the same level of resistance that it does, we could see the dollar weaken. We could also see the Japanese yen. It doesn't have to actually weaken. If the dollar weakens itself, then the exchange rate between the dollar and the yen will actually change, and we could see this level move down. If I was specifically looking for resistance levels, I would turn to my Fibonacci levels and look and see where we are. We've passed almost all of the main relevant levels, but there are still a few that remain above. Outside of this 88% level at 138, almost 140, and there's one more obscure level that should be in between the levels where we are at 135, maybe almost 136. These are potential turning points, technical levels that mathematically represent something in the markets that you see as technical analysts that could provide an opportunity to short the dollar here and get long the yen. There's also one more scenario as well. The Canadian dollar, which in and of itself is, as you might expect, tied to crude oil prices. We already talked about crude oil prices. There may be some abating of the prices, the pinch that we're seeing in crude oil going higher as we saw from the technical chart. If that technical chart holds up with what we see here in the Canadian dollar versus the Japanese yen, there is an idea, just an idea, an opportunity that we could see yet another turning point in the Canadian dollar versus the yen. Same sort of deal where we would be expecting maybe the yen to strengthen against Canadian dollars. But what would have to happen is crude oil prices would have to fall, and or some type of thing would have to strengthen the Japanese yen, like a hint of an interest rate hike in Japan. It's not very likely, but if inflation still remains elevated in Japan, and there's some reason to think so, because Japan is also a net importer, especially when it comes to crude oil. Now, again, I'm going to show you the link between the Canadian dollar, as we see here, the Canadian Japanese yen, and crude oil prices. It's not the strongest of correlations, but right now you can see from the lows of March 2020, they seem to be pretty in lock and step. Again, if we get an abatement in crude oil prices, we probably will also see some strengthening of the yen, which makes this a good currency play. So first, maybe shorting the dollar versus the yen is an option. If we get some pausing in the Fed's activity, if inflation doesn't continue to be as persistent as it is, or on the other side, if inflation continues to be persistent in Japan, or oil prices turn lower, there's an opportunity with the Canadian dollar, shorting the Canadian dollar versus the Japanese yen. This is how we use technical analysis, intermarket analysis, which is the relationships between different markets, different currencies, different futures, and also equity markets, and also the fundamental news that affects it all. The only thing that we have left remaining is, of course, the risk management, which we handle as well. So to wrap up, what do we have left? We've talked about the market sell-off, the dire situation in bonds, also how startups, IPOs, and a lot of profitless companies are now having their midnight moment. And we've also talked about the Bank of Japan and an opportunity with the Japanese yen. CPI remains elevated at 8.3%, and the Fed rate hikes are expected to continue. The things we haven't talked about, and we'll go out on this, is housing markets, and of course, maybe the U.S. labor markets, because we just had a non-farm payrolls report. Housing prices in the U.S. are starting to show some sign of cooling. If you look at just existing home sales, you can see that they've actually gone negative in 2022. And as a result, there's sort of a bifurcation here. Below 500,000, home prices are actually decreasing. Above 500,000, they're still rising. But what that's starting to show is that the real estate market, which has been red hot, may actually start to cool down. This can have some more implications for the market as a whole. Also, in the last labor report last Friday, the Bureau of Labor Statistics reported an addition of 390,000 jobs in the month of May. This was slightly below expectations, but what we're seeing is wages are up really high in May and also in the year in total. We can see just in a couple of the mainstay regions or mainstay sectors of the job markets where the average hourly earnings are up the most. Leisure and hospitality is leading the most because this is one of the hardest hit areas and it's one of the most in-demand areas. Labor force participation, which is the number of people working and people who are actively looking for work, is pretty high at 62.3%. The thing here for the Fed is this. Everybody likes to see higher wages, but the problem with higher wages is that companies having to pay and shoulder the burden and the expense of higher wages will sometimes pass this on into the cost of the goods and services that they perform, which actually increases inflation. So what ends up happening, instead of people having more money to spend, they actually are just keeping up with inflation. So it's like the wages that they're getting are just getting eaten up by inflation. So if there was actually some slowdown or at least moderation in wages and or jobs, that actually may help the Fed in achieving this balance between its labor mandate and its inflation mandate. This is an ongoing struggle of monetary policy, and it's something we're going to look at going forward because this is what's going to influence what happens in the markets, and not just the stock markets, but all of them. We hope you enjoyed this June monthly market mix. Look for us again for next month. We're going to have a much larger, much more in-depth one in July because it's going to be the quarterly and also the kickoff of the second half of the year. Make sure you don't miss it. We hope you always know enough to move forward. Thank you.